Welcome back to the channel Future Financial Pros. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeeze candidates, zooming in on one specific ticker that's caught our attention. We're going to break down exactly what makes a stock hard to borrow and what it could mean for traders. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's get into it. The stock we're focusing on today is GITS, trading under the ticker symbol GITS. This is a micro-cap company, meaning it's a smaller player in the market, often with a more volatile price action profile. Show GITS ticker and name on screen. When we look at its recent performance, GITS has seen some truly flat action. Over the last 5 days, the stock is up exactly 0.0%. Extend that to the last 30 days, and it's still at 0.0%. And today? You guessed it, GITS is holding steady at plus 0.0%. Show price chart with 0% changes. This incredibly flat price action is matched by its volume profile. Today's volume is 0 shares, the 30-day average volume is 0 shares, leading to a relative volume of 0x average. This means there's virtually no trading activity happening right now. Yet, despite this, it's landed on our hard-to-borrow screener, and here's why. Why is cost to borrow and why it matters? Before we get into the specifics of GITS, let's talk about what cost to borrow, or CTB, actually means. When someone wants to short a stock, they first need to borrow shares from a broker. They then sell those borrowed shares, hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. Brokers charge a fee for lending out these shares, and that fee is the cost to borrow. It's usually expressed as an annualized percentage. Think of it like renting a car. The more in demand that car is, or the fewer cars available, the higher the rental fee. The same principle applies to stocks. When a stock becomes hard to borrow, it means there are very few shares available for short sellers to borrow, driving up the CTB fee significantly. And yes, these fees can absolutely exceed 100% annually, sometimes by a lot. Why the stock is hard to borrow right now. Now let's bring it back to GITS. Despite the lack of trading volume and price movement, GITS is currently showing an astonishing cost to borrow fee of 932.3% annualized. Highlight CTB number on screen. That's a massive premium for any short seller to pay. Our screener also indicates an estimated float of 2.4 million shares. A small float means fewer shares are available for trading in the open market, and by extension, fewer shares are available to borrow for shorting. Our internal composite squeeze score for GITS currently sits at 42.5 out of 100, which factors in the high CTB, foot size, and other metrics, even with the current lack of volume. The high CTB on GITS right now tells us that the available supply of shares to short is extremely low. Short sellers who are currently shorting GITS, or those looking to initiate a short position, are paying an incredibly high price for that privilege. Squeeze mechanics explained. So, what does this high cost to borrow imply for a potential short squeeze? Imagine you're a short seller in GITS, paying nearly 1000% annually just to hold your position. If the price starts to move up, or if the borrower supply dries up even further, you're in a tough spot. To exit a short position, you must buy back the shares you borrowed and return them. This is called covering. When many short sellers are forced to cover their positions at the same time, it creates a cascade. Their forced buying pushes the stop price even higher, which in turn triggers more short sellers to cover, leading to an accelerated upward movement. That's the essence of a short squeeze. For a microcap like GITS with a small 2.4 million share float, any significant buying pressure, especially from short covering, could potentially have a dramatic effect simply because there are so few shares available. Dilution risk check. An important factor to consider for any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. While it can raise capital for the company, it also dilutes the value of existing shares and can completely negate or offset a short squeeze thesis, even if the cost to borrow is sky high. More shares available means it's easier for short sellers to cover, and it dampens the upward price momentum. For GITS, we've checked recent SEC filings and found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This is a positive sign for the squeeze thesis, as it suggests no immediate additional supply of shares entering the market from the company itself. Furthermore, we've found no recent reverse splits for GITS in our look-back window, which can also impact float and share structure. Remember, a high cost to borrow does not guarantee a short squeeze. It can also simply mean that short sellers have very strong conviction that the stock will eventually go down, and they are willing to pay a hefty premium to maintain their short position. Always consider all angles and risks. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given GITS's current state, a staggering 932.3% CTB, a small 2.4 million share estimated float, and zero recent trading volume or price movement, it's a unique situation. What we'd be looking for to potentially trigger any movement would be a sudden increase in volume, especially on buying pressure. To volume chart, 0.20 and explain potential spike. Any significant buying could quickly dry up the extremely limited available shares and potentially start the short covering process. Without any volume, however, the high CTB is just an interesting data point without immediate implications for price action. It's like a coiled spring with no external force applied. Its presence a textbook example of an extremely hard to borrow stock characterized by an almost unbelievable annualized cost to borrow fee. While the current lack of volume makes it a peculiar case, these are the types of scenarios that dedicated short squeeze hunters often keep an eye on. Understanding the mechanics of CTB, float, and dilution is crucial for navigating these high-risk, high-reward opportunities. If you found this breakdown insightful, please hit that like button, subscribe to the channel for more unique insights into the market, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you. Thanks for watching, and we'll see you in the next video.